and welcome. Let me ask you something. Have you ever looked at a big, successful company and heard they're having cash flow problems? It sounds kind of crazy, right? I mean, how can a company be making tons of profit on paper but still struggle to pay its bills? Well, that's the exact problem we're going to solve today. It's a super common puzzle, and it all comes down to something called working capital. By the end of this explainer, you're going to understand exactly how companies use a powerful set of tools called supply chain finance to unlock cash that's tied up in their business and keep everything running like a well-oiled machine. All right, so here's how we're going to break it all down. First, we'll really dig into that working capital puzzle. Then, we'll define what supply chain finance actually is. After that, we'll open up the toolkit and see the specific tools inside. We'll also see how this creates a win-win for both buyers and their suppliers, which is really cool. And finally, we'll look at the huge impact this has on a company's bottom line. Sound good? Let's dive in. Okay, first things first, let's tackle Section 1, the working capital puzzle. This is all about that hidden cash flow squeeze we just talked about. So this really gets to the heart of the matter. Why would a company that's profitable even need to worry about having cash on hand? You know, it's a classic mistake to think that profit equals cash. They are two totally different things. You can have $1 million in profit on your income statement, but if all your cash is tied up waiting for customers to pay you, you can't pay your employees or your rent. It's that timing difference that can bring a company to its knees. So the big question is, how do we even measure this gap? Well, the answer really begins with this term. Working capital. You can think of it as the lifeblood of a company. It's the cash that a business needs right now for all its day-to-day stuff. Paying salaries, buying materials, keeping the lights on. The textbook definition is the difference between your short-term assets, like cash and money customers owe you, and your short-term liabilities, like bills you need to pay. But honestly, the key thing to remember is that the timing of when that cash comes in versus when it has to go out, well, that's everything. And that timing gap has a name. It's called the cash conversion cycle, or CCC for short. Let's make this super simple. Imagine you run a business that makes t-shirts. Okay, so first you have to buy the cotton, right? You pay your supplier for that. Then you have to pay your workers to actually make the shirts. All that money is out the door. But you haven't been paid by your customer yet. The time between you paying for all your supplies and you finally getting cash back from selling the t-shirt, that entire period is your cash conversion cycle. And you can probably guess the longer that cycle is, the more of your own cash is just stuck, trapped in the system. Okay, so now that we have a really good grasp on the problem, this cash conversion cycle that ties up all our money, let's move on to the solution. And this is where supply chain finance, or SCF, comes in. It's kind of the hero of our story today. So what exactly is supply chain finance? At its core, it's a whole set of financial solutions designed to do one thing really, really well: optimize a company's working capital. It's all about making the flow of cash between a buyer and its suppliers way more efficient. Basically, it's a direct attack on shortening that cash conversion cycle we just talked about. Yep, and this right here is the main goal. The entire purpose of SCF is to bridge that cash gap we've been talking about, the one between paying your suppliers and getting paid by your customers. Now, I know what you're thinking. How can it help a supplier get paid faster while at the same time allowing the buyer to pay later? It sounds like some kind of financial magic trick, right? But it's not magic. It's just really clever finance. So let's pull back the curtain and see how it actually works. All right, let's jump into our third section. It's time to open up the SCF Financial Toolkit and look at the actual nuts and bolts, the specific techniques that make this whole thing possible. Okay, so generally, all of these SCF solutions fall into two main categories. On one side, you have what's called receivables purchase. This is where a seller or a supplier literally sells its unpaid invoices, the money its customers owe them, to a bank or financier. Why? To get cash right now. A huge advantage here is that this is off balance sheet, meaning it doesn't look like debt. On the other side, you've got loan-based solutions, and these are a lot more straightforward. This is when a company just takes out a loan using its assets, like its inventory or those same receivables, as collateral. So the big difference to remember is, are you selling an asset or are you borrowing money? Now, if we look closer at that first bucket, the receivables purchase one, you're going to hear a bunch of different terms thrown around, like receivables discounting, forfeiting, or factoring. Honestly, they're all just different flavors of the same idea, selling an invoice to get paid early. But there's one I really want you to focus on here: payables finance. This one is a little different because it's a program that's actually set up by the buyer to help out their suppliers, and that's a real game changer. And then on the loan-based side, it's pretty much what it sounds like. We're talking about a loan or an advance against your receivables or maybe against your inventory. These are direct, traditional loans. And because they're loans, they show up as debt on the company's balance sheet. Pretty straightforward.
So now we've seen the tools in the toolkit, but here's what makes supply chain finance, and especially that payables finance we mentioned, so incredibly powerful. It's not about one company winning at another's expense. It's not a zero-sum game. It's specifically designed to create shared value. It is a genuine win-win for both the buyer and the supplier. Let's take a look at how that's even possible.
Okay, first, let's put ourselves in the shoes of the buyer, the big company that's purchasing all the stuff. You might be wondering, why would they bother setting up this whole complex financial program just to help their suppliers? Well, the benefits for them are massive. The big one is that the buyer can extend their payment terms. So instead of paying their bills in 30 days, maybe they now pay in 60 or 90 or even 120 days. That means they get to hold on to their cash for a lot longer, which is great for their working capital. This improves a key metric called Days Payables Outstanding, or DPO. But it's not just about hoarding cash. By making sure their suppliers are financially healthy and not struggling, they build a much stronger, more reliable supply chain. And of course, all that cash they're holding onto can now be used for other important things, like investing in new projects. Okay, that all sounds fantastic for the buyer. But hang on a second. What about the supplier? They're the ones being told, hey, you're now going to have to wait 90 days to get paid instead of 30. On the surface, that sounds like a terrible deal for them, right? And it would be, except this is where that win-win magic really happens. So here's the brilliant part. Even though the buyer isn't going to pay for, say, 90 days, the supplier has the option to get paid by a bank on day 1 or day 2, whenever they want. This dramatically improves their key metric, Days Sales Outstanding, or DSO. But here's the absolute best part. The interest rate, or the fee for getting that money early, isn't based on the small supplier's credit risk. It's based on the giant, super creditworthy buyer's credit rating. This means the supplier gets access to cash at a much, much lower cost than they could ever get on their own. It's fast, it's cheap, and it lets them grow their business without taking on a bunch of expensive debt. So we've seen how this helps both sides operationally. But now let's zoom out for our last section and look at the really big picture. Why do the folks in the C-suite, especially the chief financial officer, get so excited about this? It's because SCF doesn't just make things run smoother. It fundamentally transforms some of the most important numbers that measure a company's health. The first big one is free cash flow, or FCF. You'll often hear investors call this the king of all financial metrics, and for good reason. It's the actual hard cash a company has left over after paying all its bills and investing in its future. This is the money that's used for everything that makes shareholders happy: paying dividends, buying back stock, paying down debt, or making big, innovative bets. And as you can imagine, SCF gives a huge direct boost to free cash flow. The second metric is called Return on Capital Employed, or ROCE. This one sounds a bit complicated, but the idea is simple. It basically measures how good a company is at using its money to make more money. Think of it as the financial bang for your buck. Obviously, a higher ROCE is always better, and SCF can make this number look a whole lot better too. And this table really says it all. This shows the before and after impact, and the numbers are just staggering. Just look at the buyer. Their free cash flow more than triples, jumping from 20 million to 70 million. And then look at the supplier. Their cash flow goes up by more than 6 times, and both of their ROCE numbers get a healthy boost. I mean, these aren't just small incremental improvements. This is a total game changer for both companies. This is the proof, right here in the numbers, of that win-win we've been talking about. So let's wrap this all up. We started with the working capital puzzle, that big cash gap that can trip up even profitable companies. And we saw how supply chain finance provides the perfect solution. It's this incredible toolkit that creates a genuine win-win. Buyers get to hold on to their cash longer, suppliers get access to cheap early payments, and the most important financial metrics for everyone involved get a massive boost. So that really leaves us with one final big question to think about. Is a company's supply chain just another cost center to be minimized? Or is it actually a hidden source of financial power just waiting to be unlocked? What do you think? I'd love to hear your thoughts, so please leave a comment down below. If you found this explanation helpful, a like on the video would be amazing, and make sure you subscribe for more deep dives just like this one. Thanks so much for watching.